Hey everyone, welcome back to Retire on Dividends. This is Jordy, and today we need to talk about something that's probably got a lot of you feeling a bit worried. The massive tariff announcement Trump just dropped on Wednesday. So the markets are freaking out right now, and if you've been checking your portfolio, you might be seeing a lot of red. The S&P was down over 3.5% yesterday. The NASDAQ fell almost 6% at one point, and the Dow dropping about 4%. That's the kind of market reaction that can make anyone nervous, especially if you're building a dividend portfolio for retirement. But here's the thing, as dividend investors, we approach these situations differently than most people, and that's what I want to talk about today. First, let's look at what actually happened on Wednesday, what Trump called Liberation Day. He announced a baseline 10% tariff on basically all imports coming into the United States, but that's just the start. For about 60 countries with large trade deficits with the US, he's imposing much higher reciprocal tariffs. China got hit with a whopping 34% tariff, the EU with 20%, and other major trading partners like Japan, South Korea, and Taiwan are facing tariffs between 24 to 32%. These tariffs start taking effect between April 5th and April 9th. So this isn't some distant threat. It's happening right now. Now, I've been through these market panics before. Remember back in 2018 during Trump's first term when we had the first trade war with China? Markets reacted similarly, lots of panic, doom, and gloom predictions, and sharp sell offs. But then what happened? The market adjusted and eventually continued upward, and that's the first thing we need to remember as dividend investors. And like these short-term market moves don't define our strategy. We're in this for the long haul, focusing on companies that generate sustainable cash flow that can be returned to us as dividends. And let me share something Warren Buffett said back during the 2018 trade tensions that still applies perfectly today. He said, if you have a decent business, I mean, you don't buy a stock that wiggles around, you buy into a business. The business is going to be here 5 years from now and 10 years from now. The United States is going to grow over time, and businesses are going to generally do well. That's our mindset. We're not buying stocks that wiggle around. We're buying businesses. Now, as dividend investors specifically, what should we be doing right now? Let me break this down. First, remember that share price drops aren't the biggest concern if you're a long-term focused dividend investor. What matters most is dividend safety. If you're holding solid dividend paying companies and their share prices drop 20%, while their ability to pay dividends remains intact, that's actually an opportunity, not a disaster. Second, red markets are actually the best time to invest if you have cash available. Think about it. If a solid company in your portfolio is yielding 4% before and now yields 5% after a sell off, you're getting 25% more dividend income for every dollar you invest going forward. That's the power of adding to positions during market downturns. Third, not all dividend sectors will be affected equally by these tariffs. Based on my research, the energy sector might be less impacted since energy products were largely spared from the highest tariffs. REITs focused on service businesses rather than retail goods should also be more insulated. Even business development companies, BDCs, that primarily target service-based companies may weather this storm better than others. The sectors likely to be hit hardest are consumer discretionary companies, those selling products like electronics, apparel, or other goods that depend heavily on imports. You'll want to check your portfolio to see your exposure there. What I'm doing personally and what I've been focused on in previous episodes of is maintaining core positions in solid dividend ETFs. Whether you prefer SCHD, VYM, DGRO, or another quality dividend ETF, these provide diversification that can help weather these kinds of storms. Remember our discussion about Bugglehead principles in episode 2? Low cost, diversification, buying and holding, and simplicity. These principles become even more important during market turbulence. The diversification built into ETFs like SCHD gives you exposure to hundreds of companies, meaning you don't have all your eggs in one basket if certain sectors get hit harder by tariffs. And think about our episode 4 discussion on yield max ETFs. And this is exactly why I cautioned against over reliance on high yield tactical positions. When markets drop significantly, you need that core stability. This doesn't mean you can't use yield max ETFs as part of your strategy, but keeping them as satellite positions while maintaining a strong core helps you navigate these volatile periods. So, what should you be doing right now? If you've built your portfolio according to the principles we've discussed in previous episodes, you might not need to do anything dramatic. This could be a good opportunity to review your dividend safety, RAM, look at the payout ratios and financial health of companies in your portfolio to make sure they can maintain dividends even if revenue drops temporarily. Consider deploying any available cash strategically, or maybe add to your core positions that have sold off but have strong dividend safety. Stay diversified. If you've been meaning to add some sector diversification to your portfolio, a broad sell off can create good entry points. Remember Peter Lynch's wisdom: there's always something to worry about in the markets, always. But businesses with strong fundamentals tend to adapt and overcome these challenges over time. I mean, look, I've been through market panics before and they're never fun. Your portfolio value drops, the media is in full panic mode, and it feels like everyone is losing their minds. But as dividend investors, we have an advantage. We're focused on the income our investments generate, not just their price. If your dividend payments keep coming in and maybe even growing during this time, that's what matters most. And historically, good dividend paying companies have been more resilient during market downturns because the ability to pay a dividend is itself a sign of financial strength. I'd love to hear your thoughts in the comments. How are you approaching your dividend portfolio in light of these tariff announcements? Are you making any changes to your strategy or staying the course? As always, thanks for watching Retire on Dividends. If you found this helpful, please hit that like button and subscribe so you don't miss future episodes as we navigate this market together. Until next time, keep building that dividend snowball.